Our next guest sees opportunity in two corners of the market, even with higher rates. Joining me now, Avery Sheffield, CIO and Senior Portfolio Manager at VantageRock. Welcome back. It's good to see you.
Great to be here.
So, rising rates aren't going to wreck the whole story.
They won't wreck the whole story. No, because there's a reason why rates are rising. Rates are rising, but the economy is fine, right? We saw with the payrolls number. We saw with wage growth still 3.9% year over year. We saw the small business optimism index recently. The data points that are coming out are suggesting that the economy can withstand higher rates.
So why are we reacting this way?
Well, we're reacting this way because valuations are very high in many areas of the economy. And, of course, higher rates over time, high enough rates, will slow the economy. But the question is, which companies actually can do well in a higher rate environment and have reasonable enough valuations that there's real still asymmetric opportunity to the upside?
Okay, so you're not naive to the fact that rates are rising. It's not like you think everything is going to work. There are going to be winners and losers.
Absolutely.
Where are the winners?
Yes. So I think that the two of the areas that are most interesting to us are airlines. We've seen from the results this week.
Yeah, Delta.
Exactly.
Wow.
Yes.
I think it was a record high.
Yes, right? yes. And also banks, but I can speak a little bit more about airlines and why they're so interesting, because I think they're controversial, right? And you look at the stocks, you're like, wow, these look like they're poised for a bruising if anything goes wrong. Higher rates, potentially higher oil prices, like aren't these going to be terrible for them over time? And so, look, first, I'll just say the number one bear case that I think people should pay attention to is higher oil prices, because they're very sensitive with fuel as a meaningful part of their cost structure. What was interesting is on the call this morning, the company said that this is the highest pass-through of higher oil prices into rates that they've ever seen, because the industry dynamics in the airlines have changed, I think, for an extended period of time, because the low-cost carriers have gotten to a place where their cost structures, because of are such a burden that they've had to shrink capacity and raise prices. And what that means is that the legacy airlines are in a much better place. To be quite frank, everyone's going to be in a much better place, because if capacity growth continues to be lower than GDP growth, they'll all get pricing. And with better pricing, they'll get better earnings. And you're talking about companies that are still trading in the single digits.
Well, I mean, Ed Basten this morning was talking about 2025 being their best year ever.
It should be their best year ever.
Even in the face of, Brent hits $80 today and WTI's in the high 70s. Now they have a little more leverage because they have a refiner.
Yes. But all of the airlines should benefit if the industry structure remains this strong.
But the stocks are already up a lot. Doesn't that matter? I mean, United was a double last year.
But it was at 4 times earnings in August. So, you start off at 4 times earnings and your earnings increase, you're still at a mid-single digit multiple. I mean, we've seen what's happened to companies that start off at a reasonable valuation and have an earnings fluctuation. These companies are some of the cheapest companies in the market. So I'm not allowed to speak about individual names, but there was a soft lines retailer that was trading like it was going to go bankrupt a few years ago. It's up 10 times. Right. So I think if you think that the industry structure is not sustainable, then you want to be bearish. If you start to see capacity creeping back in a way that is risking being greater than GDP growth, then you run for the hills. But I think the management teams all understand that they need to keep capacity growth constrained. And the most aggressive players historically have been those at the low end of the market that have disrupted the apple cart. Okay. And we don't expect that moving forward.
Worst sector today, financials. You want to talk about the banks. They're going to start reporting next week. Some say higher rates. Why isn't that supposed to be good for the banks?
I actually think that this is going to be a false move today. I think that they're going to do better next week. By the way, the airlines were selling off into the prints this week and have actually, are doing quite well and recovering. Look, I think that the nice thing about higher rates in this type of environment is we're at higher rates because the economy is strong. Credit still remains benign. The Fed really wants to cut rates, right? But the economy is so strong they can't. If higher rates actually start to create any issues, they're going to be very quick on the trigger to lower them. So you're getting this steepening yield curve, and you're getting a steepening yield curve because the economy can withstand it. That's a very good environment for NIM. You also have M&A activity, really picking up. And then, as I mentioned, the benign credit trends and still reasonable valuations. Not dirt cheap valuations, more expensive than the airlines. But I think that this is an environment where the large money center banks can do well. And then add to that decreased regulation, potential pullback of Basel III, reduced capital requirements. They could just like chug along this year quite nicely.